I find it fascinating how most people lose the bigger picture over time. Bitcoin was created at the height of the global financial crisis, when banks got bailed out with taxpayer money, when the monetary base was expanding, when the dollar was worth less and less. Yet Bitcoin is used to speculate on its price. What we see here, the vertical line, that's the creation point of Bitcoin at the beginning of 2009. The chart shows the S&P 500, so US equities, relative to the monetary base. It's a very long-term chart. It starts in 1959. We can see how stocks aren't necessarily that safe of an investment. As in, stock valuations measured versus the US dollar supply can go down by 74%. And it can take decades until the purchasing power is restored again. This here is a time window of 36 years. Since Bitcoin's creation, we have never seen a real crisis anymore. The first crash we see over here, that was the .com bubble burst. The second crash we see over here, that's the global financial crisis. And so that's not just theory. Satoshi Nakamoto, the creator of Bitcoin, made an inscription into the very first block, the Genesis block. Have a look at this over here. This is the raw data. It's a reference to the newspaper The Times. Chancellor on brink of second bailout of banks. Here is that newspaper article. The politicians had been forced to bail out the banks to prevent a systemic collapse. Right? There was this term that was coined during the time. Too big to fail. If this particular bank is failing, then all the other banks will fail with it because there's so much inherent leverage in the banking system. There's fractional reserve banking, so the deposit that you have at the bank is just a claim versus that bank. The bank actually doesn't hold the dollars. They only hold a small fraction of the dollars. And so Bitcoin was intended as a solution to that problem. Now this is the US money supply over time. Over the last 66 years, it grew annualized by 6.8%. Now the official inflation rate during that time is much less. It's on average 3.3%. Where does the disconnect come from? Why do consumer goods not appreciate by 6.8% per year when the monetary base is expanding at that rate? I think the reason for that is first population growth, but secondly, more important, productivity growth. So assume we had a constant money supply, which basically Bitcoin is representing. Once we've got a constant money supply, because we become better and better at producing things, things should actually go down in price versus that constant monetary base. But we don't see prices going down over time because the monetary base is expanding faster than our gains in productivity. It's very hard to grow productivity by more than 6.8% per annum. And so during the bank bailout, in order to prevent a systemic collapse, the central bank bought the bad debt of all the smaller banks. And that massively increased the Fed balance sheet. It went up by 151%. And so Bitcoin was created just a few months after that event. But there wasn't a good price feed of Bitcoin for a few months because it was still a very small experimental project. This second boost that we see here, this was the COVID bailout. What we see here at the bottom, that's the Bitcoin price. So you can see how much did Bitcoin actually help to protect against the monetary debasement. The COVID crash is over here, where then subsequently the monetary base expanded and Bitcoin appreciated since that COVID crash by more than 2,000%. Now that was not necessarily the intention of Satoshi Nakamoto to outpace monetary expansion by that much. However, there's also an adoption curve to a new hard money. And so even when we see the Fed balance sheet shrinking, we still continue on our long-term rising trend in Bitcoin. If there is zero additional adoption of Bitcoin from here, if everybody already has enough Bitcoin and doesn't want to add more Bitcoin, if no new investors come in, then over time we should see at least 6.8% growth in the price. Because that's how quickly the monetary base is expanding. So that's the absolute minimum return. But of course we are way beyond that minimum return because we still see more and more adoption. And so we really have to ask ourselves, why is now politics supporting Bitcoin, supporting crypto, supporting stablecoin? Donald Trump signed the Genius Act that gave regulation for stablecoin issuance. And stablecoins are very hard to stop when it comes to money laundering or when it comes to insider trading or terrorist financing. Why is the Trump family even creating a decentralized finance protocol to issue a new stablecoin, the USD1 stablecoin? Now, there's of course the argument that politicians want to get support by as many voters as possible, and many people in the US support crypto. But that would only explain positive regulation. It doesn't necessarily explain that much engagement in the space. I think the US simply wants to get more US dollars in the hands of more people, because there's this fundamental problem of more debt piling up in the US. And it's not just the US dollar amount that's a problem, it's actually the debt relative to the GDP, which is at a historical high. The US has to come out of this somehow. They have to be able to reduce this ratio. Otherwise, the financial stability of the entire system is questionable, right? The higher this goes, the more tax revenue has to go to the debt holders, thus making the government weaker. Unless, of course, the currency is more devalued. And that's the point here. Now, in the past, we had very classical cycles. We had our expansionary cycle, where a lot of risk-on assets went up in price. Then there was potentially some overinvestment, which subsequently caused the next depression, where prices went down. Now, because we allowed the market to clean itself, because we allowed for those price declines, there was some demand for risk-off assets. There was some demand to also hold some bonds. Bonds were considered risk-off. They were considered more or less risk-free. But because we don't allow a real crash anymore, because we print our way out of any inconvenience, like here, the COVID crash, there's less and less desire for a risk-off asset, especially a risk-off asset that might devalue over time due to monetary debasement. Now, don't get me wrong, the smart investor is becoming more and more cautious. Warren Buffett, for example, has a historically high cash rate in Berkshire Hathaway. This here is the Shiller PE ratio. It shows the price to earnings ratio of the S&P 500, and it's very close to the levels that we saw at the peak of the dot-com bubble. Maybe this current peak will go into the history books as the AI bubble. Maybe there's some overinvestment here. I'm not saying that AI won't be useful in the future, but I am saying that maybe, very similar to the internet in the past, we might see a contraction of the sector first before we see real economic use. This is the S&P 500, again, relative to the US money supply. Bitcoin was created over here, and we are at historically expensive levels. And here is the tech sector relative to other stocks. Again, we are at historically high levels. This here is the dot-com peak with the subsequent crisis. And so it's surprising when valuations are that high that demand for government bonds isn't that high. Yes, Warren Buffett is holding T-bills, but really the government is trying to find ways to spread a potentially inflating US dollar further across the globe. And stablecoins are one potential mechanism to do that. Now, there are some people that are thinking out of the box and that simply get into another risk-off asset. For example, gold. This is the gold price relative to the monetary base. This chart, again, is quite long-term. It starts in 1959. The dotted line here, that's the average gold price, or the average ratio of gold to the money supply. They were currently at very, very high levels. We haven't seen those high levels for a long, long time. There was only the end of the 70s where gold went higher compared to the current levels. Now, what is causing this rally here? Why did gold outperform the monetary base by 150%? Besides, of course, the desire for less risky assets and the doubt to just get into US dollars, because the monetary base can expand. I actually do not think that it's the average investor that's buying into gold. The gold rally is not driven by people getting into the ETF or by people buying physical gold. Here's the gold ETF holdings measured in US dollars. Here's the year-on-year gold ETF change. This is now measured in ounces. So with the recent rally over here, we have seen roughly 16 million ounces getting purchased per month. 16 million ounces equates to 500 tons. And so have a look at what the central banks are buying. They are also buying roughly 500 tons every month. Now, the central bank purchases are more constant than the ETF purchases. With the ETFs, there's a bit more speculation. But since beginning of the year, both sides are buying at equal rates. And so that caused a roughly 50% increase in the gold price. It seems like this trend is relatively constant. It seems like this is not turning around. Both entities continue to buy month over month. And so maybe this historically high price of gold isn't even that much of a problem. Maybe it does make sense to own some gold, at least as an insurance policy for the portfolio. And probably it's better to have this in physical gold than owning it in an ETF, because we don't know what happens during a real crisis. Let's imagine the US dollar has to inflate even quicker than 6.8% per annum. Let's say the demand for US government bonds shrinks even quicker. It will be extremely interesting to see what happens in case we have a massive crisis. Will Bitcoin again outperform the rest of the market? Will Bitcoin actually become a risk-off asset? Will it actually trade like gold? Will it actually go up when then tech stocks suddenly fall? Because in the past, it was always traded as a risk-on asset. During the COVID crash, when stocks on average fell by 30-35%, Bitcoin went down by 60%. There is still positive price correlation between Bitcoin and the tech stocks, but maybe at some point there will be a decoupling. Right now, gold still seems to be the best hedge, and the purchases through the central banks and through the ETFs are rather constant. But maybe once Bitcoin hits the all-time high relative to the monetary base, maybe then people will shuffle around to other assets. We are not there yet. We are still quite far away from this. So gold could potentially still outperform the monetary base by 190% in the extreme case. But at this point here, what's going to happen? It's very hard to say. People will not like to own US dollars, but maybe around here tech stocks are again cheap enough to buy. Currently, of course, they are extremely expensive. But we are talking about the scenario of a potential crisis where tech stocks underperform the rest of the market again, where people don't believe in the quick monetization of AI infrastructure. Now, most people try to beat the market by reading the news or by following the narrative of the day, but I don't think that that's a good approach long term. Most people just follow their gut. I think it's better to use statistical data analysis. Try to figure out what kind of rules worked in the past that might continue to work in the future. So you might know about this. I have back-tested moving averages for Bitcoin to try to find out when are we bullish, when are we bearish. It's a trend following strategy. We buy whenever we are above the moving average. We sell whenever we are below the moving average. Now I've back-tested all moving averages from the 2-day all the way to the 200-day. And the 125-day simple moving average and the 44-day simple moving average are the ones that historically work the best. That's the two moving averages we see plotted over here. So the 125-day is the line in turquoise, the 44-day is the line in orange. Now have a look at the historical performance versus buying and holding Bitcoin. So we are betting on rising prices whenever we are above. We're betting on falling prices whenever we are below. This is the 125-day. Buying and holding Bitcoin would have given us this performance here in white, but the back test gave us the performance in turquoise. Here's the same for the 44-day simple moving average. We can see, first of all, that we outperform long term, but also that our volatility is lower, as in the drop from top to bottom is less compared to buying and holding Bitcoin over the same time period. Now, when we've got an approach that tends to perform more and still is less volatile, still drops less compared to just buying and holding Bitcoin, why don't we lever this up? So I tried to find the optimal leverage. If you go long, the best leverage is 2.75. If you go short, the best leverage is just 1x. If you have the same leverage for both directions, long and short, then 2.25 is the best. But in general, I think it's better to have different leverages to go harder on the long than on the short. So this is the 125-day simple moving average. If we only go long, we never go short. So whenever we are below the moving average, we're just in cash, we're just going sideways. And here is the short side. So we never bet on rising prices of Bitcoin at all. We're only betting on falling prices. And of course, that underperforms buying and holding Bitcoin. But still, it shows us that even though in a long-term appreciating asset, if you can only bet on falling prices, we can still make some return. And so let's say we use the 44-day simple moving average, but we don't just have 1x leverage. So that's that. But instead, we lever this up with 2.75 on the long side, with 1x on the short side. This is much better than just going 1x. And again, this is a logarithmic scale, right? So each horizontal line here is at 10x from each other. So that's my preferred medium-term approach for Bitcoin. I just look at where is the price currently relative to those moving averages, and then I position myself in the long or short direction And because this might be cumbersome, this might be complicated for a few people to always enter and exit those trades, I've also opened up a capital trading pool for the premium members. They can simply just deposit capital and then I will execute that exact strategy and I won't deviate from that strategy. So if history is any indication, we might get performance that looks similar to that over time. At least that's the idea. We don't want to just follow the news or act based on gut fear. We just follow rules that historically worked well. This was a very quick rundown, but there's way more details in the tutorial section of Premium. The link is down below. It's bitcointrader.com. But I'm also sharing my personal view on the market regularly. So every 3 to 4 days, I publish a Premium update video where I share what kind of trades I open, where I share what kind of positions I take. There are more details regarding the strategy in Premium. They're dedicated videos for that. There are also dedicated videos that explain how to actually run the backtest, how to make those backtests yourself, if you want to do this maybe for Ethereum or for any other crypto asset. And so here is the Bitcoin strategy moving average vault. So that's the trading pool. You just deposit some money into that pool and then I will execute those trades automatically for you. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you do not like Premium, just message me within 1 week and I will refund you 100%, no questions asked. A link to Premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.